Passive retirement income. Is it real or is it just a nice marketing phrase? In a perfect world, I think that every everyday investor would prefer investments that could produce a passive income, which could then return the original amount that they invested at the end. Interest, dividends, rent, or coupon payments. These are, or these should be, like the reward for coming up with the money to invest in the first place, right? So, what's so bad about passive retirement income? Well, unfortunately, in practice, in my view, it's not actually that efficient. And in some cases, chasing income as part of your investment strategy can actually carry more risk, not less, than one that produces no income at all. So, in this episode, I'm going to walk you through some of the most common pitfalls that people walk into when they go about trying to build passive retirement income. We'll explore why fixed does not equal guaranteed, what most financial advisors recommend, and an alternative strategy to fund retirement that I think could be more appropriate for investors who understand the difference between risk and volatility. Now, if you don't know me, my name is Darcy Ungaro. I'm a qualified financial advisor who works with investors prepping for and entering into the best years of their life. While some of my own investments, including property and shares, produce rent and dividends, and while initially I had aspirations to build this up to replace my income at the end of my career, that's no longer my own strategy. And it's no longer a strategy that I can dogmatically dish out to my own clients. I'm now of the view that the higher the income is from any investment I hold, the less efficient that investment could be to hold in the new world. Now, a quick disclaimer in case it isn't obvious, which it should be, this isn't personalized financial advice. No one person has the same circumstances, of course. So naturally, what I talk about today may not be appropriate in some ways for you or for other people. But if you do find value in this episode, then please share your thoughts, like, subscribe. Let's begin. First up, fixed does not equal guaranteed. This is the DIY trap that catches a lot of investors out. Before we go any further, a little bit of a language cleanup might be required here. When most people talk about passive income, what they really mean is a form of income that comes from deploying capital, investing some money. Maybe it's interest from a bank savings account or term deposits. Maybe it's dividends from profitable companies. Maybe it's rent from commercial or residential property, or even coupon or interest payments from bonds. The word passive makes it all sound rather effortless, though, right? And even in some cases, risk free. In a similar vein, the phrase fixed returns can imply the investment is more certain, it's more trustworthy, and even guaranteed. But in reality, passive income should instead be labeled income, and fixed should instead be labeled regular or set. I don't know, just an idea. Just because the interest rate is known up front, guaranteed implies someone with deep pockets is actually promising that you're going to get your return and your investment back no matter what happens. But that's not necessarily true. Words matter. And when these two ideas of passive income and fixed returns get mashed together, this is often where a lot of the troubles can begin. But let's wrap some numbers around this to give you the flavor of what people are actually out there trying to accomplish. Imagine that you're in a position where you have $1 million dollars and all you're after is $50,000 a year, but you don't want to touch that original $1 million. You want to make sure that you get that back when you're done with it, maybe in 30 years or so. So that's basically a 5% return, simplistically speaking, ignoring inflation, fees, and taxes. If the safest options out there are only giving you 3% or even less, though, you've got a massive gap here to fill. And this means that you're going to need to take on more risk or more uncertainty of outcome to chase a higher return. That's exactly when the 8 to 10% fixed offer starts to appear in your Facebook or Instagram feed. It becomes the magic solution that you've been waiting for. And because these fixed, secured by property ads often pop up when you search for things like term deposit or low risk investments, it's really easy to mentally file them alongside bank deposits. It has a fixed rate of return. There's a clear time when you need to invest this money. Plus, you know that property sits there in the background securing it. So, well, it feels like a low risk investment, even when it might not be. In reality, these investment returns, while they offer set income returns, derive these returns from loans that are being made to a type of borrower that often mainstream banks don't want to touch, or if they do touch them, they will only take them on with much stricter terms. So, as an investment advisor, unless you had conducted a high degree of research and you were investing a relatively small amount into several of these schemes, personally, I'd probably tell you to run a mile from these so called fixed returns. Why? Well, firstly, you're taking concentrated risk. A lot of your money is riding on just one issuer, one sector as well, property, and potentially maybe even one project that they're lending to. Secondly, you're taking an unacceptably large amount of credit risk, which is the chance that the borrowers simply don't pay you back on time or at all. Again, fixed does not equate to a guarantee that you're going to get your money back. We've even seen with the FMA, the Financial Markets Authority, which is New Zealand's financial market policeman, if you like. We've seen them formally warn multiple wholesale property outfits recently for this activity. They've gone after them for promoting high return, low risk messages through broad advertising targeting ordinary investors searching for simple products and accepting eligible investor certificates on very flimsy grounds. Now, to be clear, not every investment out there is rotten, but it shows how easy it is when you're looking for predictable investment returns to end up accepting far too much uncertainty than you bargained for. Now, here's where it's probably easy for me to come across as being quite hoity toity and high and mighty and look down at everybody else for making these types of mistakes. But in reality, I've actually learned this the hard way myself. About 8 years ago, there was a fractional property owning scheme that I put a small amount of money into, as it provided a share of the rent. I would get a share of the rent, plus I would get a share of the capital gains when the property was eventually sold. It was such a good investment, in fact, that the provider went broke. And not only did I lose my share of the rent and potential capital gain, but I kissed my initial investment goodbye too. Given it was a wholesale offer and I signed off myself as an eligible investor, which I was allowed to do, I didn't read some of the information and do more due diligence like I should have. I should have done more research, but I didn't. And I really have no one else to blame but myself. It's easy to do. But on that topic, investing in a wholesale offer may mean that you miss out on a product disclosure statement, sometimes known as the PDS. This document normally lays out the risks and the features in plain language for non experts. It's basically like a warning label so that you can understand what's in the tin before you buy it. And this means no ongoing monitoring by the regulator, and you might not have access to independent dispute resolution schemes, or there might not be a licensed supervisor standing between you and the manager if things go wrong. Now, that doesn't automatically make the investment bad, remember, but you do need to recognize that you're giving up safety rails when you tick that wholesale box. Okay, so now that you know that fixed does not equal guaranteed, if you are looking for a set amount of income and you want to preserve your investment, what would a financial advisor recommend? Well, most advisors recommend bonds, also known as fixed interest investments. Bonds or bond funds, which is a group of a whole bunch of bonds owned through a vehicle, through an investment fund. Well, these are one of the more trusted ways to turn a lump sum of money into a more predictable stream of investment income. But what are bonds? Well, bonds are simply loans that you're making as the investor. You lend to a government or to a company. They pay you back interest in return, also known as coupon payments, and hopefully they give you your capital back at maturity. Now, there are three big risks with bonds, and a good bond fund will help manage all three. Firstly, we have interest rate or duration risk. Now, if you've got a 5-year bond paying you a return of 6%, and later on, new 5-year bonds are available, but they only pay 4%, well, your 6% bond looks better. So people are willing to pay more for it, and therefore its price goes up. Now, unlike a term deposit where you just get interest, a bond or within a bond fund can give you both regular payments and an extra capital gain. Now, of course, with all investments, it works the other way around too. Flip it, reverse it, and if interest rates rise, your bond becomes less valuable. This is exactly what a lot of investors experienced in 2022 and 23. If your bonds were issued when rates were just 2% and the market suddenly wants 5% rate of return for bonds, your 2% bonds look pretty awful, so their price will fall. You still get your coupon payments, and if you hold to maturity, you should still get your capital back too, but on paper, your value of your bond has just dropped. This is what duration risk is all about, and why owning a bond in a fund, along with other bonds with different maturity dates and interest rates, can desensitize your investment to the changes in the market. Next up, there's credit risk. This is the chance that the borrower won't or can't pay you back in full or on time, either by missing interest payments or coupon payments, or failing to return your money at the point of maturity at the end of that bond term. Governments and companies can default or come under enough financial strain that their bond prices will fall, even if they keep making payments for a while. Now, investment grade bond funds, where bonds are rated by major agencies as more likely to pay you back on time, spread this credit risk across many issuers and sectors, so no single default should define your outcome. One of the New Zealand bond funds that I use as an advisor, for example, holds a diversified mix of New Zealand government and corporate bonds. So credit risk is spread out not just across a lot of bonds and different issuers, but also between public and private sector borrowers who have risks that are quite different. Now, like any diversification, there is a trade off. Holding a single higher risk bond directly might give you more yield or higher capital gains, but a diversified fund that holds a lot of bonds will usually mean slightly lower headline returns, but in exchange for a much lower chance of a catastrophic capital loss. Lastly, we have systemic risk. Now, this is the edgy one that almost no one ever talks about in the glossy brochures about bonds and bond funds, but I think it really matters. As it relates to interest rates, the last 40 years, the trend has been falling interest rates. And why? Well, to stick to the mandate of creating positive rates of inflation, central banks globally and in a coordinated fashion have all moved over the last 40 years to lower interest rates, lower lows and lower highs with each cycle there is. Lower interest rates over time generally have the impact of causing all investments to rise in value, and bonds are no different. So, owning bonds over the last 40 years actually made pretty good sense. You received a reliable stream of income as well as occasional capital gains as rates continued their march downward. So, a balanced investment portfolio, as an example, which usually contains about 60% growth assets or shares and 40% bonds or fixed interest, provided a nice balancing act between potentially strong returns from the growth assets with the reliability of returns from the bonds during the same time. But now, many believe that we're in a different regime. We're in a world of very high government debt with periodic talk of currency resets and a growing gap between reported inflation and what people feel when they're buying groceries or paying their rates. And why is this relevant? Well, if we ever reach a point where people stop believing official inflation numbers, or if governments tolerate higher inflation as a way of eroding their debt, then the whole idea of locking up money at a fixed rate of return starts to look less like safety and more like risk. Sure, you will get your money back, but what if that money is not worth the paper that it's written on, right? Simplistically, this is what systemic risk in bonds might look like. It's not a conspiracy theory, it's just acknowledging that bonds rely on trust in currency, trust in financial institutions, and trust that the inflation statistics are accurate. Just ask the Iranians right now who have recently discovered with their own financial system that trust is not, in fact, fixed. Now, in spite of all of what I just said about bonds, a diversified bond fund is still a good way to create investment income preserve capital, and provide an option to store money that's going to be spent within 5 years. It's a good temporary parking spot. And that's why, for investors that are chasing retirement income, most investment advisors will still default to recommending bonds and bond funds. They're not the perfect solution, but they are the least bad way to get consistent returns compared to a portfolio which is purely growth assets like shares. There's no single way, though, to create retirement income. But so far, I've spoken about what not to do, what an investment advisor would get you to do. And now, here's a more outside of the box strategy that you may wish to learn more about. I call this the grow first, then harvest strategy. It's a supplemental or even alternative way to build retirement income by leaning on capital growth rather than yield or income. Instead of living off that interest from the bank deposit or the rent from the property or the dividends from the stocks, you stay in liquid growth assets like shares, property, and even alternative assets like precious metals and Bitcoin. But you're not in it for the income, you're in it for the gains. Because some of those investments don't produce any income at all, you have no choice anyway. The only way to get a return is to progressively sell down those investments to fund your lifestyle. And this might sound risky, relying on capital gains to actually live in the future. Sounds really risky. And in a way, it is, but not always in the way that we've been taught. We've often been told that volatility, where prices bounce up and down sharply over short periods of time, is the same thing as risk. But in reality, the more significant risk is the chance of a permanent loss of capital or running out of money before you run out of life. Now, if you understand that your portfolio will rise and fall in value, and if you've planned out your withdrawals so that you can still take the income that you need without being forced to sell into a bad market, then the day to day volatility is more noise than danger. The real risk shows up when you can't meet your spending needs anymore, and that's more a function of bad planning rather than bad investments. Historically, growth assets have beaten bonds after inflation, even with a bumpier ride along the way. So, if, and that is a big if, you can accept more volatility, this may be the more efficient way to create a type of income in retirement. Sure, the old 60-40 mix of shares and bonds may still work well to cushion market movements to smooth out that bumpy ride, but the real risk to watch out for, in my view, is that the future works out quite different than the past. Bonds were great during a particular interest rate era, but it's not a law of nature. And this is why I think for some, simulating income by selling down investments is a valid alternative to living off of yield or income. Now, would I ditch bonds altogether? No way. There's still value in holding bonds to store money that you want to spend in the short term. And there is still value for some diversification, but perhaps in smaller quantities than advisors have historically recommended. So, how does the grow first, then harvest strategy work in practice? Well, step one, grow first. You keep a decent slice of your wealth in growth assets for a longer period of time than what has historically been recommended. Now, it's really important for these growth assets that they are liquid. Holding a high value home in Auckland's North Shore, which is waterfront on a slightly dodgy cliff edge, that's maybe a growth asset, but it's not very liquid. Holding a portfolio of tech stocks mixed with companies that do and make stuff, well, that's liquid and it's growth. Much better. The second step is the harvest part. After you've held these investments for a long period of time, it's time to harvest. Harvest a little at a time. You sell units gradually for cash that you spend. You may also want to consider a strategy with higher cash reserves to fund periods of time where the share market is going through bad periods of time. There can be years where the share market is not performing well, so you'd hate to be forced into selling your investments just to fund your lifestyle. So if you had a decent amount of cash or some money in a bond fund again, then this avoids locking in losses when the market is down but the big holiday is still coming up that you need to pay for. In summary, though, passive income sounds great, but treating fixed as guaranteed and chasing high property backed yield is a fast way to take on board more risk than you ever intended. The boring advisor approach of using diversified bond and income funds still has a role because it spreads interest rate risk and credit risk across many issuers. But just be aware that bonds aren't likely to be the superhero they once were in the last interest rate era. For some, then, the grow first, then harvest approach may be more suitable, keeping more in liquid growth assets than deliberately selling down over time is the way to go. It can be a more efficient strategy as long as you respect the volatility and keep some cash and bonds as a buffer. Obviously, every investment advisor will have a different take on this, and I totally respect that, as you should also if you have one that disagrees with this approach. They're probably taking into account other factors in your world that need to be taken into account before you go forward. If you are a DIY investor, though, and you haven't mapped out when you'll need your cash, how long your money can stay in your investments, and how easily you can turn each asset back into cash without a fire sale, then it's time to allocate some time to review your portfolio for yourself. Take a hard look at your whole portfolio, though, your KiwiSaver, your managed funds, direct shares, and property. Ask yourself the question, what would I or what could I cut loose when, and how quickly could I turn this into cash if life or if the markets changed? If you want help working out your own mix of growth and income certainty, then feel free to grab a free 15-minute discovery call with me. Learn about how I work as an investment advisor. The link to make contact is in the notes. Thanks for watching. We'll catch you in the next one.